trading strategies. So the first session, after the first session, we'll have a short break. So I'll let you know when we'll have the break. So yeah, let's start. Can anyone give me a confirmation if my presentation is visible?
Yeah, it's visible.
It is.
Okay, thank you. So yeah, the first is on introduction to trading strategies. Again, like yesterday, we have a disclaimer. So this workshop is for educational purpose. The things discussed here should not be considered as an investment advice or trading advice, and any loss incurred due to buying and selling of securities are not linked to the speakers or to the workshop. Okay, so what is the outline of today's session? So we have we'll start with trading rationals. What are different trading rationals? Then we'll continue to looking at the overview of our trading system. Then we'll see what are the risks of automated systems. So yesterday I have praised quite a lot about automated trading systems, but it's not all gold. We have some issues with trading systems, automated trading systems and automated executions. So we'll discuss the risks associated with it. Then we'll continue towards looking at types of trading strategies. So what are the main types of trading strategies that you can find? So mostly, and two of them are like momentum and mean reversion. So we'll discuss momentum and mean reversion in depth. Okay. So the two very common trading rationals that are available are like a discretionary and a systematic. So what a discretionary trader is, what comes to your mind when you think of a trader, mostly there is a guy sitting in his desk with multiple monitors, flashing indicators, charts and all those, and making decisions at the real time, taking trades based on his intuition. So most of it, what they call is it's an art. Okay, I have some intuition in that these things will perform well, so I'll place this trade according to some intuition. You cannot, he cannot describe it properly sometimes. So that is the discretionary view of trading. So on the other hand, we have a systematic, which we will be focusing on. So most of the quantitative trading, quantitative finance are based on a systematic approach. So what's the system? If you see here, I could find a photo of a discussion trader, but there is no photo of systematic trader. So systematic trading is basically like a bunch of researchers, they develop some trading rules. Those are very hard and rigid, and they code it into a trading strategy, and they put it into production, and they run it on the market. So basically what I found is I could do best is this flow chart of how systematic trading takes place. So moving forward, about systematic trading strategies. So systematic trading involves, as I've said, it involves instructions and steps that can be executed by an algorithm. So since there are clear instructions and steps, it can be backtested, and whatever risk of that system can be quantified using historical data and quantitative models. So this is not the case with a discretionary trading. So that's the I consider the main issue with discretionary trading is whatever logic the trader might have used, that cannot be quantified and backtested because it's not hard logic. So that's the main issue with discretionary trading. Going forward, if you heard the buzz of algorithmic trading, systematic trading, the buzz will be because of the third point, because it avoids human cognitive biases and risk associated with human emotions. So basically, as I've said, discretionary trader involves a person taking the decision at the real time. So he might have some rules, but at the end, he is the one who is placing the order. He is the one who is taking that decision to do that trade. So at any moment of time, human emotions might kick in. And also there is that thing always, like humans are very error prone. So at any moment of time, there might be an issue and he might go wrong. So there is always that thing. So going forward, this is something I have discussed yesterday. Like someone asked me a question like, why algorithmic trading? Why systematic trading? So see, there are complex strategies which are not possible for humans, such as high frequency strategies, as I've discussed yesterday. So high frequency trading involves like speed and precision. So speed and precision are two things like that is far from the domain of human expertise. So speed and strategies cannot be done manually. So for that you need some algorithm. For that you need some machine. Whatever machine can do, humans obviously they can't do that. Like there are certain steps that are repeated over time. There are things that needs to be done in a specific order, and it's need to be repeated over multiple instances. So like as I've said, like if you want to trade a trading strategy at the single market, like as I've said, like if you see this picture here, there are multiple monitors. He might be watching multiple markets, but he, he is limited. He is limited to a certain sets of uh, what is a certain set of markets, certain set of instruments that he can like see over here and process in the brain. But there is no limit what an algorithm can do. It's only limited by the resources you can provide. You have enough resources, you can do analysis on as many instruments you want, as many securities you want. So moving forward, the final point, like that's the thing, like systematic trading can be fully automated. Like it can run without any human intervention. Like here, this guy might have some strategies in his mind, which is like, event based. Certain events occur, okay, he have this thing in mind, okay, I'll do this thing. But that is some logic, I would say fuzzy logic, which cannot be like written as a rigid rule. But systematic trading involves some rigid rules. So like it is developed that way. Like researchers go through the historical data, do some research, do the back test, and at the end make sure that whatever conclusion they arrive to, that is like based on the rules they have created. Like they will assume some hypothesis, and based on that hypothesis they will try to prove that hypothesis. So that's just rules. So that is the reason it can be fully automated. Okay, finally we'll see an architecture of trading system. So this is like a very simplified version how a trading system would look like. So at the top we have like data. Obviously data is the heart of like systematic trading. Without data you cannot do, like most of the systematic trading strategies, I would say not most, almost all of the systematic trading strategies depends on data, some sort of data. So here at the top layer you will see there is a real-time or historical market data. Not necessarily market data, it can be any data in this layer. Like you can be like it can be anything. Like nowadays, like this word is very famous called alternative data, but this includes like things like satellite imagery, weather data, and all those. So it can be any data sets. So it goes to the second layer of the, this whole part is a trading strategy. It goes to a layer of our trading strategy which is called trade generation. So it generates signal. Also it is sometimes called as alpha model. So it generates those alpha signals. So this model generates those signals. So those signals are then passed through a portfolio construction model. So what it does is that the signals generated by alpha model are combined using a portfolio construction model for having that optimal risk profile. Like suppose you're trading over a basket of stocks. Suppose you have a 50 and you generate signal for each of them. Now how will you trade them optimally so that like you should avoid the market risk and the risk involved with the correlation with the stocks of with the stocks within the stocks and other factors. So that is done using something called a portfolio construction model. So you pass those signals to a portfolio construction model. Those are combined. Those signals will combine, and finally, those combined signals is passed to a trade execution model. So trade execution model converts those signals into like orders that is passed to the exchange or the brokers. So yesterday I have given you a task, right? So that task is like a sort of a like execution model. So I've said you to execute $1 million worth of Apple shares. So how to sell $1 million worth of Apple shares without moving the market significantly, without having market impact? So that is done by this part of the trading strategy, trade execution model. So then the orders are passed to brokers, and then brokers on exchanges they report the fill, and the fill can be then analyzed by post-trade analysis. So post-trade analysis is done like to analyze what is that a cost involved in the transaction and all those, and that is feedback to the trading strategy, and trading strategies can use it for various purposes. And whatever you have executed, now some market data is generated according to that, and the data is again fed into this layer of data. So yeah, that's the basic overview of trading systems. Okay, now coming to the risks. So what are the risks associated with automated trading system? The first and foremost would be like extreme market events. Trading systems are designed for particular market regimes and conditions. And when like those extreme conditions occur, like what do you mean by extreme conditions? Like suppose the regime shifts. It is a upward trending market, it goes down. It is a like moving like a mean reverting market, and it changes regime to like trending market. So those are called market regimes. Suppose there is sudden market crash. So those are extreme events. Those happens, very rare. Those are very rare events. So when those events happen, like if your algorithm is not prepared to take real-time decisions based on when those regimes occur, then it may not be able to take the decision what to do, and may lead to some adverse effects. So whatever so yesterday I've said about like May 6 2010, the flash crash. So flash crash, why it happened? Like the algorithm, whatever algorithms was present, like HFT algorithms, they weren't able to react to whatever is happening. So that was the main reason. Like, so whenever developing automated trading systems, we must take into account this thing, like the extreme market events. The second thing is like why automated trading systems are criticized is mainly because of lack of transparency. People say it's a black box. It turns so complex that the researcher is not able to understand why it generates signal. So what is the black box? Black box is certain type of, consider literally a black box where you put in some data and it outputs something, a signal, something, a trade, or like maybe it gives out money. Okay, for the good reason. So it gives out money, but you don't know why it's making money. That algorithm is making money. That is, that is, although it's making money, you should not trust on that system because you don't understand that system. Unless you like really know why it's making money, it's very difficult that you should have trust on that system. And actually you should not employ the system, like you should not deploy that to production. So that is the thing, like most of the HFT strategies, even some of the systematic strategies, like those involve machine learning, like deep learning and all, those are considered very black box because you cannot understand that why it's taking the decision. The third, this is like, it's not rare that bug in the algorithm. There might be bug, like there might be a very good chance that you might not discover that bug for ages. And when that certain events in the market happens, that bug will kick in. So when this systematic trading strategy gets so complex, like it turns into a black box, okay, then those chances of having those bugs exponentially increases. And I have given two stories regarding that. The first one is regarding a HFT firm, and that lost nearly like $440 million within a blink of an eye. As I've said, HFT is about speed. So within a blink of an eye, they can make money and they have lost money. So that's the thing. Okay. So types of trading strategies. So mainly like you can classify the trading strategies into three types according to me. So whatever trading strategies you see, that can be classified into these three types. The first is like momentum. So momentum is like you see this like there is some asset or some sort of fund that is like trending upward. Then if you want to invest in that thing and you make money, that you made money on the momentum. So let's call it, not necessarily it is going up, but if it's going down, you shorted that thing, you made money on the downturn. So that is the momentum factor. So some strategies that exploit this thing are time series momentum and cross-sectional momentum. These two are very popular. We'll discuss time series momentum in this session. The mean reversion is about like reverting back to the mean. The idea is that markets or whatever like the asset you're trading, like, or basket of assets you're trading, the assumption is that the price will revert back to the mean. So if you see here, it is going up and down, and here is the mean of the price series, and it's reverting back to the mean. Like it says that it won't go very far from the mean, and if it goes far, there is a high chance that it will revert back to the mean. So this is mean reversion. So mean reversion strategies are like you short it when it goes below the mean, like crosses some threshold below the mean. You long it and you exit it when it comes to the mean, and you similarly you short it when it like goes certain threshold above the mean. So that is the main intuition. So some mean reversion strategies are statistical arbitrage. There is also time series, like you can do it. Some people do it on, like to do it on a single security, like that is called a time series mean reversions. And there is also pairs trading, so which is very popular. So we'll discuss pairs trading in mean reversion part. There is a third type called market making. So we have discussed market making yesterday also. So they are market makers. So they provide liquidity to the market. So how they profit is like I've discovered a bid spread. So they try to profit from this spread. We'll discuss this if we have time at the end of the workshop. So we'll discuss this thing. This is slightly what to say, this is slightly less popular because this can, for executing this, you need a very good infrastructure, and you need mostly a direct market access. So okay. Okay, so I think you have the link, right? You can go to the link and we'll see the notebook. It's a Jupyter notebook. We'll see time series momentum first. Oh, I think I have it open. Okay. So what's time series momentum? Time series momentum tries to exploit, first of all, I think I need to zoom in a bit, maybe. Yeah, it's perfect. Okay, time series momentum tries to exploit the anomaly same behind cross-section momentum. So what is cross-section momentum is like you have some basket of, you have two basket of stocks. You put like stocks in two baskets. So one is assumed to have like uptrending momentum, and one basket is assumed to have downtrending momentum. So whatever stocks are having uptrends, you put in the first basket. Whatever is going downtrend is put in the second basket. You long the first one, short the second one. As like if they move apart from each other, both the baskets move apart from each other, you make profit. If they don't, like you make a loss in that. So that is the thing, like that is the momentum. It uses the momentum. So this is done on a single asset. So time series momentum, for that you don't need two baskets. So you just can do it on a single stock or a single security. The idea is that security is trending in direction up or down in past. It's assumed that it will continue moving in the same direction. So like if it has a like upward momentum in past, it is assumed that in future it will also have an upward momentum. So that is the reason you go long in the security. And same thing for downward. If it's going downward in past, it is assumed that it will go downward in future. So you short the security. So I've imported some data. So this is S&P 500 prices. So this is the head of the data. So you see this is all the S&P 500 prices. So specifically we'll look into Apple. Okay. So I plotted the price of Apple from January of 2018 to like September of 2020, like before September. Yeah. Okay. So you see here, like there are some clear trends. Like here, you can see a clear uptrend. Here is a downtrend, uptrend. Here's uptrend, uptrend. Here's a downtrend. Okay. So a simple strategy would be to use something called a simple moving average. So what's a simple moving average? So simple moving average is like taking for that you need to define something called a window size or a window length. So whatever the window length is, suppose it's 10, then you will consider past 10 days price, and you will take the mean of that, and you continue sliding that window, like 10-day window. So if if the window started on t equal to 0 to t equal to 10, now the next window will start from t equal to 1 to t equal to 11. So continue calculating the mean of sliding that window, and whatever you get, that is the moving average. So it's a simple moving average. So this is the formula how to calculate the simple moving average. So what we'll do is we'll calculate two moving averages specifically. So we'll find something called a fast moving average and a slow moving average. So the fast moving average will have an window length of a duration that is lower than the window duration of slow moving average. So if slow moving average has duration of 50, then I'll consider the window length of fast moving average as 20 or something less than 20. Okay, so then this is the faster one. So how the trading signals is generated? Okay, before going to that, let me show you how it is computed. So as I've said, I've taken fast and slow. This is the window length, so 20 and 50, and I've done a rolling window over this series of Apple and calculated both, and I plotted them. So you can see. So this blue one is the faster moving average. So it is more sensitive to the recent events. So it's more sensitive to recent events, and slower moving average is less sensitive. So it uses more data, like from here, this part. So you might have seen like the data from this is missing because it uses the data till this point, and the first mean was calculated at this point, and then it's slide the window by like one step and calculate the mean again, you plot it here. So that's how it's done. So you see like both of them are crossing each other at some point. So you can see they're crossing here, 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 here. So how will generate the trading signals? If the faster moving average crosses the slower moving average, then we'll generate a buy signal. So what do I mean by that? If the faster moving average, so the blue one, if the blue one crosses the purple one, will generate a buy signal. So why that is? That means that whatever the current mean is moving upwards than the past mean, like the slow mean. The fast mean is moving upward. So the recent things are going upward. So that means we have something, we can say that it has a positive momentum. So we can go long on that momentum. Okay. And whenever the faster moving average crosses the slower moving average from bottom, then generate a sell signal. So faster moving average, from the top, then generate a short signal. So here, if you see, the faster moving average crosses the slower moving average from the top, and we generate a short signal that is like sell. So that means that the current mean is going slow and it's moving down, and the previous slower mean is like still up, so that means like the current thing is going down, so a negative momentum, so we'll do short. So yeah, this was about momentum. This is the simplest explanation of momentum, that, and you can do as complex as you want. You can go really complex in this. Okay, so next we'll discuss pairs trading. So for pairs trading also, I have given you a link. You can go to the link. So this is from different something called an organization that was there called Quantopian. So they prepared this notebook. I really like this notebook. I have studied pairs trading from this notebook, so I'll use their notebook. It's from Quantopian. Okay, so the idea behind pairs trading is that you have two securities, you have a pair of securities. Okay, and the idea is that they have some economic link. Okay, and that economic link, you can model it using some model, like that is the crux of pairs trading. You have to model that economic link, and it is assumed that if they're linked economically, then their prices are also linked in a way. So if prices move apart, or like if prices have some like if they don't move together, they show some weird behavior, then that is considered as an anomaly. As long as that economic link is there, it is considered as an anomaly. So you can exploit that anomaly. So how to exploit that anomaly is like the main gist of pairs trading. So exploiting that anomaly. Okay, so we are generating two fake securities. So first one, we're generating some return from a standard normal distribution, and those return is scaled by 50, and you have this price series. Okay, so this is some fake security considered X, and we have some security Y, which is derived from X, that is like scaled by 5, and it is, and some noise are added. Okay, some random noise are added. The noise is also standard normal, so it is distributed, the distribution of the noise standard, some noise is added. And if you see this, then you will see that Y is nothing but plus 5 plus some noise. So Y is derived from X, so there is clearly a link at the beginning itself. There is clearly a link between X and Y. So if you plot that, you'll see this. So you can see like the movements are very similar. Like if it's going down, this is also going down. If it's going up, this is going up, going down. Yeah, very similar movements. The thing we want to exploit here is that whenever like this behavior doesn't happen, like if suppose the blue is the X, if X moves some weird direction, like the opposite direction, and this is going up, then we know that there is a clear link between these two securities, and that shouldn't happen. And we assume that it will revert back to the mean. So this is the mean. So whatever the mean between these two securities are, so mean is actually can be calculated by taking the spread. So spread is the difference between these two. So if you do Y minus X, so Y minus X, you can get something like this. This is the plot. So this is the Y minus X. It will look. And if you see, however they go apart, so the positive they go, that then more they are going apart, and the negative they go, then more they are coming close. Like if it's coming closer to 0, then they're coming close. If it's going far from 0, it's going apart. So if you see, the mean is around 5. So if it's going away from 5 here, that means it is going apart. If it's coming closer to 5, then it's like it's coming back to the mean, which is the normally like whatever the distance between them is. And if they cross each other, then they will go negative. So you see that most of the time when they go apart, they always come back to the mean. So this is the hypothesis. So this is the thing that we are assuming, that it will always come back to the mean, and we'll exploit that thing. Like whenever it goes apart, like we'll buy it, we'll buy the spread, what do you mean by buying the spread? If you want to buy at this point, then that means it is low, right? So low means this is higher and this is lower. Okay. So we want to buy the lower and sell the higher. So we want to buy the Y and sell X at this point. So this is buying the spread, and selling the spread means opposite. We'll short Y and we'll buy X when it goes in the opposite direction, in this direction. Okay. So how to establish that it is coming back to the mean? Like we call that thing how to know that if this series is stationary, that is, it will always come back to the mean. That can be done by something called a co-integration test. So if you see that co-integration, like it has a hypothesis that it will always come back to the mean. Like I will not go in more depth into co-integration. It is you can read more about co-integration, what co-integration does. So if you do the test, you will get a p-value. So in hypothesis test, you get a p-value, right? So this will give you a p-value between if you do co-integration, check co-integration between X and Y, it will give you p-value. And the hypothesis, null hypothesis is that they're co-integrated, and alternate hypothesis is that they're not co-integrated. So since this goes below a significance level, like consider the significance level, confidence level to be 0.05. So this is the confidence level, so 0.05. So it goes below that. So we accept the null hypothesis that they're co-integrated. So X and Y are co-integrated. We can also check if they're correlated. Okay. If you see here, there is a clear correlation between these two things. You can, by looking at them, you can like say that there is some sort of correlation between X and Y, and it is fairly strong, yeah. And if you find the correlation, you see that it's not only like correlated, it's very strong correlation. So correlation of 0.94. So you can find a correlation between them. So you see here what is the difference between co-integration and correlation. So it's shown here. So this is correlation without co-integration. So correlation is there, but no co-integration. So they're just moving upward, but they're going apart. They're going in the same direction, but they're going apart. That mean between them is not constant. The mean is varying. So if you see, mean of the spread is varying. And if you see co-integration without correlation, then it is this. These two series are co-integrated, but not correlated. The mean stays at the same point of 20, but their movements are not similar. So what is the strategy actually? So strategy is like going long on the spread, as I've said, when the spread becomes larger, that is longing Y and shorting X. So this means longing the spread, as I've said before, longing Y, shorting X. And shorting the spread means shorting Y and longing X. This is when that spread is larger and it's expected to become smaller. And when spread is smaller and expected to become larger, then we long it. So that is when it's going down. Its spread is small and it's expected to become large. So when you have like so you have a universe of stock, whatever universe, you have some, first of all, you need to have some prospective securities where you want to search if they are like some if they're pairs or not. So you will not find like you'll not have pairs pre-made. So you have to do research on yourself, like search for those pairs. So basically pairs trading is two-step. Okay, first of all, it's finding the pair, and then second of all, it's trading the spread. So you can divide it into two stages. So finding the pair, in you can do it like either you can use correlation, the first method, very simple method, but that is not reliable based on some resources. And the second is like going with the co-integration. So you have some n number of stocks you picked, and you want to find co-integrated pairs between them. So how do you do that? You run something this function, like you iterate over each pair, and you check the p-value, and whoever has the p-value less than 0.05, you consider them as prospective pairs. So here are a few lists of securities where they're searching for promising pairs. So among this is like SP500. So this is an ETF of SP500. It's called Spider. So they're considering the 1 year data, and these are the prices of them. And when they run it through like this function, searching for pairs, then they found only a single pair to be like co-integrated. So they have plotted the heat map of the p-values of each pair. So if you see this pair, only this pair has a p-value like, you know, below 0.05. It's very dark green. So yeah, rest of them are white. That means it's somewhere middle of this. So it's like between 60 and 40%. Not significant at all. Okay, they have shown us the co-integration, and you see the p-value. P-value is pretty low for this. So, and now after you found the pair or pairs, now you can move to the second stage where it's like trading the spread. So first of all, trading spread, you need to calculate the spread. There is various methods. So one of the method is like running a simple OLS regression. Okay, simple OLS regression. So I'll explain this further about how this works out. So you need to find something called a beta. So beta is also known as the hedge ratio. You find the hedge ratio between the two stocks. Okay. So hedge ratio is basically known to be like the common. So if you see here, hedge ratio is multiplied by the first stock minus the second stock gives you the spread. So hedge ratio is something that is similar between that, like that scales S2. Okay, that is scaling the second stock. So the thing in the first stock that is scaling in the second stock. So you eliminate that, and whatever is left, you take this as the spread. So that is done on these two stocks. So this S1 and S2, and you find this as a spread, and this black line is the mean again. The second method is taking the ratio. Just take the ratio of the. So taking the ratio, you get the spread as this. So this is also a mean is, this is the mean of that. Going further, you cannot trade the like spread directly. Like it's not good to trade the spread directly because like it's not standardized. Like how you don't know how much from the mean it needs to move to make a position. Suppose like you say that if it moves like 5 unit away from the mean, then I will make the trade. So 5 unit away, you mark a like line here and here, 5 unit apart from the mean, and you make the trade. But that may not be the base position. So if you see here, you'll get some drawdown. So if you take position here, like you short it here, it still rises. You made some like unrealized loss here. Of course, like it will come back to the mean, but you made some unrealized loss here, and you lost the opportunity of like if you could entered here like shorted at 40, then it could have made much more profit than entering at like what to say at somewhere here like 32 or 33. So that is the thing, how to optimally enter a trade. So for that, you need to standardize this whole series. So that is like done using like assuming that series is normally distributed around the mean. Okay. And you standardize using something called a z-score. So you have done that in statistics too. So you minus the mean and divided by the standard deviation. So that gives you the z-score. So when you plot the z-score, now things looks much more standardized. The mean is 0, and whatever like the assumptions whatever the ideas are applied to a standard normal, you can apply it here. Like you can find a significance level, and according to those significance level, you can make the trade. So at 99% confidence, at 95% confidence, you can make those trades. So yeah, so here it is placed at +1 and -1. So whenever it goes below -1, you make a long, you go long. Whenever it goes below +1, it makes short. You can make it like 2 standard deviation. This is standard deviation. Okay, this is 1 standard deviation apart, and you can make it two standard deviation apart. 2 standard deviation apart, you will have less frequency of trades, but those trades will be like more profitable than those single trades which have been generated with 1 standard deviation apart. So that is the thing, like you need to control the frequency, and you can control the frequency, and you can control the profitability, like using the standard deviations. Okay, the same thing is explained, like go long when it goes below -1, go short when it goes above +1, and exit position as it approaches 0. There are some other methods like using moving averages to smooth the signal of the spreads. So like so that you can apply real time, like for the idea of using moving average is that you give importance to like nearer data, like the recent data. So whatever data is recent, you give importance to them for calculating the spread. So okay, so this is also a method. You can read about this. I'll not explain this method. Okay, the final thing is that a caution. So I have told you about the economic link. So I made a statement that as long as they're economically linked, their price is assumed to behave similar manner. Okay, but as soon as that economic link breaks, so here we model the economic link using co-integration. So as long as the co-integration is they're co-integrated, then we can trade in that strategy. But as soon as the co-integration co-integration no longer stands, then we cannot, like it is not good to trade in the strategy, because now according to your hypothesis, they're not linked. So if they're not linked, their prices are not linked. So if you see, like after a year, they have taken, like after 2015, they have taken and 1 more year data, so up to 2016, and they have tested the co-integration, and the co-integration no longer holds in this period. So after 2014 to 15, they were co-integrated, and after 15 to 16, like after 2015, they were no longer co-integrated. So yeah, you can read this notebook. This is very useful notebook. You can read about like the implementations and all. Okay, so we're getting back to the slides. Okay, so we are approaching end of the session. Okay, the references. So we have I have given 3 books and 3 papers. So the first one is Algorithmic Trading, Winning Strategies and Rationale by Ernest Chan. So second book is also by Ernest Chan. It's Quantitative Trading, How to Build Your Own Algorithmic Trading Business. So these 2 are good, like if you want to know how algorithmic trading works. Like the first one specifically, it explains implementation of pairs trading, momentum trading, and all those things. It is a strategy book, so it will give you like strategies, including the code, but the codes are writing in MATLAB. So yeah, that's the caveat. And the third one is systematic trading. So this is systematic trading is by Robert Cover. So this is a good book, like if you want to learn about system trading, what are like advantages of system trading, how to do a system trading, so how to set up system trading, so those things. Now coming to the papers. So the first paper is about time series momentum. So these are all the benchmark papers for these strategies. Okay, so first is a time series momentum. The second one is very classic paper on pairs trading. So this is by Gavitt et al. And the final one is the benchmark paper of momentum strategies. So it's Jagdish and Titman. So yeah, now I'm open to questions. Okay, Vinay has raised. Yeah, Vinay.
Yeah, hi. I have
Hi.
a couple of questions on the strategies today.
Right.
The first one is with regard to the time series that we discussed.
Momentum.
The first one. Yeah, the momentum. Yeah. So we talked about the fast and the slow moving average. And we have taken a longer duration for the slow moving and the shorter duration for the fast moving. So my question is with respect to the selection of the time periods. So does it change based on the duration of a trade? For example, if I'm a day trader or if I'm just a 5-minute trader or I'm a long-term investor, do we change the fast and slow moving averages? I mean, what's the statistical way to go about it?
Okay, so that is like way another topic. Like it's about optimization. So optimization is like a whole topic on its own. So it needs a workshop on its own. So
Okay.
it's a vast topic. How to optimization, how to not overfit. So we'll talk about backtesting. Okay, how to not overfit. We'll talk about backtesting these strategies, whatever we discussed today. So I'll backtest this in the next session. So after the break, like we'll take a short break after this, after the Q&A session, and we'll continue with the backtest. There I'll discuss about backtesting these strategies. But whatever you have talked about, choosing that window period, that the length of the window, so that is optimization. So that is a different topic. Like it involves like lots of concepts on its own.
Okay, but there are some best practices that are already there which we can select from, right?
I wouldn't say that, because like this is a very simple strategy. It is never employed like by like any serious trader in market.
True.
Like, yeah, this is like just for like I did it just for explaining the time series momentum, how it works. So today's end of the day task is like based on a time series momentum. So it's a different one. I'll show you how to implement that. That is also a simplified version, but like these kind of simple strategies are never employed like on the market, like never used, because they're pretty simple to make money. Yeah.
True. I mean, they're more like for academic.
Yeah, they're just for understanding, like showing out, like giving an understanding. This is a very basic workshop, so I used that strategy. Like I could have, as I've said, like you can go as complex as you want with time series momentum.
Sure. The second one was the pairs trade. So just try to understand what type of securities fit into it. Say, for example, if we take SBI, State Bank of India, that being the lead public sector bank, and we see the other public sector banks for taking the lead of SBI in terms of the prices. So when we observe that SBI goes up, say Corporation Bank also goes up, SBI goes down, the Corporation Bank also with a lag goes down. Does that fit into the pairs trading strategy? Those two securities qualify for it? I mean, at an intuitive level.
See, that is now become a discretionary thing. Like whatever you said, like you used your intuition to like derive some sort of link between these two strategies, but in reality that might not be. Like you don't have any statistical evidence to prove that they're linked. So either you find some economic link, like you say like they belong to the same sector, so they have that link. Okay, like I might say airlines industries, they belong to the same sector, so I'll pick 2 airline stocks and I'll trade them because they're same sector, they're linked that way. So yeah, I could say that, but going some intuition wise, that becomes like very discretionary according to me. Yeah.
Okay. Continuing with this pairs trading, we said when the beta is fairly close to 1, we say that it works. But can we work on pairs trading for a negative beta? I mean, when one goes up and the other goes necessarily down. I mean,
yeah,
that's
definitely.
A contrarian strategy.
Yeah, you can work on that also, but for that, like your sides will flip. Whatever you're doing, it will Correct. Flip. Like yeah,
the spreads will flip.
Yeah.
Okay. All right. Thank you.
Yep. Hi, Sune. You can unmute.
Hi. Can you hear me, Harkishan?
Yeah.
So I just wanted to ask you, like I mean, so evidently, like coding is a very important skill to do back testing for any form of quantitative trading or something like that. So I just wanted to know, like what are the skills that would be required to, let's say, if I wanted to pursue a long-term career in something like financial engineering or quantitative trading or something like that? Just in general, because like, so the thing is that I'm also working as a quant developer in an options trading firm based out of Bombay, and I am well versed with the jargons of options trading, and I know like Python as a programming language, but I am still very confused about how would the career progression look like. Maybe if you have any ideas about that.
Okay, so regarding financial engineering, so financial
Right.
engineering is mostly about like having strong background in mathematics, strong background in statistics, strong background in programming. So if you have those three, then you are very good to like choose that as a career option. Like finance is something that is not very complex on its own. Finance is very simple.
Correct.
It just
Right.
there are jargons involved, but the concepts are really simple. The thing is that when it comes to financial engineering, it uses lots of complex mathematics. So if you understand those mathematics, then it's good.
So I've always heard that there's a lot of mathematics required in that,
Yeah,
but like,
you
would you, let's say maybe a topic or something? Because I just don't
yeah
understand it
topic.
coming in
Okay,
my day-to-day life or something.
okay,
Like,
I'll say
even
it's
when
asset
yeah.
pricing. It's asset pricing. So if you check asset pricing involves like very complex, like it involves stochastic calculus. So and like very it involves yeah very strong concepts of statistics. And
Okay.
if you check asset pricing, okay, like there are
Okay. Okay. Yeah. So
like
asset
black short.
pricing as a topic under mathematics or financial engineering, right?
Yeah, asset pricing is like is a topic, is a subject on its own, is a field. Like it's very crucial. Like as you said, you're on the field of options trading. So options trading is done like using asset pricing. So you need to know what is the how that option is priced. So you may heard of something called a Black-Scholes model, right?
Right.
It's a
Yeah.
Black-Scholes Martin actually. So yeah, so Black-Scholes model, it is derived using
To
to
price an
understand the
option.
derivation. Yeah, to understand how it's derived, you need to have knowledge of stochastic calculus. So
Correct.
that is where, and in many field, like most of the recent developments, optimization and all those, like recently I've said about optimization, right? So optimization topic on its own, to know how to optimize a trading strategy, you need to know various fields of mathematics. Like it involves like synthetic data generation. So for generating synthetic data, you must know like what is the data generating process like behind an asset. So yeah, it gets very complex once you go into it.
Okay. Okay. So you would recommend that I just look up on this thing called asset pricing in financial engineering.
See like if you want to get the like if you want to know how much mathematics is involved, I would say that go for check asset pricing and check it. But if it's
Okay.
not the field that you are interested in, then I'd highly like what to say, stop you from like going into that field of asset
Right.
pricing. Like there are many subfields inside like quantitative finance. Like you can
Correct.
be on the side of data, like you can process data, you can clean data, you can like you get good with the data. The other thing
Right.
is like doing feature engineering. You understand why things happen. You understand the models, why it's working. Like as I've said, black box, you want to convert black box to something that can be understood, that can be explained. So yeah,
Correct.
there are
Okay.
many, like
Okay.
you can also go to like strategies. The most popular thing in the market is just alpha, like people looking for alpha. But alpha is just a part, and like
Mm.
you don't even know if that alpha is like working or not. It just maybe just luck. Okay,
Mm.
but what is not luck, what is under your control is risk management. It's understanding the volatility, understanding the bet sizing. There are many things. So
Right.
that is under your control. Rest of them are very uncertain. Like alpha is very like there is like saying like that was going on, like a bunch of researchers, bunch of quants get together and develop some sort of alpha signals and get some trade out of it. And there is one chimp who is throwing a dart on a dart board where there are a bunch of stocks, and the dart hits a stock and they buy the stock, that
Yeah.
the team perform better. So yeah,
Yeah.
that's the
The
thing.
monkey experiment in Wall Street.
Yeah,
Yeah. Oh, yeah. Also, just the last request. I think if you are also a student of this program, or then is there any way by which, let's say, we can make a form of a community or something, or a WhatsApp group or something? I think because the thing is that I do not really know many people in this field of interest, so it would be great to share ideas and grow together. So if you could only take the initiative of forming, let's say, what even if it's a WhatsApp group, it would be a really beneficial thing.
definitely. That was what I was talking about yesterday, right? We shared a form like that was related
Right,
to
the
our
Discord
Discord,
group one.
yeah,
Yeah.
Discord community. Like definitely, like what I was planning to do is, like, after this workshop gets over, we'll form some sort of a reading group where we'll discuss research papers, research articles related to quantitative finance, field of finance, and
That's amazing.
yeah,
Yeah.
also related to things that I don't know really, like DeFi
Right.
and all those space. Yeah.
Right. Wow, that would be great. That would be great. Thanks a lot. Yeah. Thank you so much.
So yeah, like guys, if you haven't joined the Discord, then the link then join the Discord, and make sure that if you haven't got the role of this workshop, make sure that you get the role, so that like you can join in the conversation.
So I think only a form of Google of getting into the Discord was shared. I don't think the Discord joining link as such was shared.
The form had the link. The form had the link in top.
Oh, I think I've not. If you can share it again. Yeah.
Yeah. Shankaran has shared. Thanks. Okay.
Okay. Thank you, Harkishan. That was all. That was all. Yeah. Thank you.
Yeah. Anyone else have any questions?
Probably I just would like to add a point here
Yeah,
with
sure.
respect to the academic paraphernalia that is needed to venture into the field. I mean, there are certain certification courses by some reputed universities from the east coast of USA, and there's also this certificate in quantitative finance from Paul Wilmot. So, not suggesting that one should do that, but in case somebody wants to know, what it takes to get into this field in terms of the mathematical rigor, the statistical knowledge, what type of libraries are used, why Python, why not any other programming language, and why C++, etc. I think if you can just see one of these universities' curriculum, then you'll be having a good idea. So I can suggest one link, which is Certificate in Quantitative Finance. Just type ckf.org, and you'll be able to download the brochure and just have a feel of what it takes to get into financial engineering and quantitative finance. It's pretty rigorous in mathematics, equally rigorous on programming, because ultimately you're putting all the models into Python program. So it takes a bit of effort and practice.
Yeah. So any one of you have any other questions? If you don't have questions, then we'll go into a short break. So we'll return by 8:15. Meanwhile, like if you have any question, you can ask me like after 5 minutes. You can ask me, like I'll be back within 5 minutes, and rest of you can take the 15-minute break, and we'll start at sharp 8:15. So the next topic will be on backtesting and trading strategies. Welcome back, guys. So hope you had the break. So we'll go forward with the session. So the next is on backtesting. Okay, I hope that you can see my slides. Okay, backtesting a trading strategy in Python. So again, the disclaimer that this is just for educational purposes, and the speakers are not responsible for any losses occurred due to anything implemented from this workshop. So yeah, please read the disclaimer, it's important. So again, the outline. The outline is that first we'll see why backtest is important. So why we need to even bother to backtest. Then the second is what are different methods of backtesting. Then types of algorithms used for backtesting. Then we'll see how to analyze a backtest. What are the different metrics that are used for analyzing a backtest. Then finally, we'll see the backtest of the time series momentum and the pairs trading strategy. Okay, so the motivation backtesting is that this is a question that came to people's mind that okay, we have a hypothesis of a trading strategy, but we don't know that if it works or not. The only way that they can test it then was like use it in the live market, just trade it, and if it fails, that they think that okay, it's not working. That's great, like we lost money and done. But as influx of data came, like electronic exchanges came, then there were abundance of historical data. So what people came to do is like they took those historical data and whatever their trading strategy was, they started like passing those historical data through that trading strategy and looked at the performance, whatever the performance was. Now it's like we have algorithms. We can code a backtest algorithm and we give it data and it will run through entire data and it will give us this performance. So you see here, like it is passed through a backtest. This is the backtest report. So something like this backtest report will be generated. We'll look into it. What are this means? What are Sharpe ratio, Kalman ratios, and all those like kurtosis and all these things means. Okay, so backtest is the process of testing historical performance of a trading strategy. It is used to check if a trading strategy worked on the past and what performance we can expect in the future. If it works in the past, like we can like sort of imagine like okay, it should perform this way in the future, at least this way. So we can get the estimation from historical performance. Backtest is a simulation which is performed and used to do the challenge check of a hypothesis. So you have a hypothesis in your mind. So this is and from the hypothesis you create a trading strategy and you do a check on the hypothesis if the hypothesis even works on the market scenarios, real market scenarios. But the thing is that the backtest is not an experiment and it should not be aimed to prove the profitability of a trading strategy. It's just a historical performance. So you might have heard that the historical performance doesn't like necessarily reflect the future. So future might be different. So backtest should not be considered as an experiment for proving. Okay. So continuing on that, like why, like I've told you like why people backtest, but backtest is not an experiment because of some reasons. That reasons are very stated on like this paper is called 7 Scenes of Quantitative Investing. So these are the 7 points. Like the first point is on survivor bias, survivorship bias. So survivorship bias is what, like ignoring the stocks that have gone bust or delisted in the past, or only considering the existing stocks in a sample. So suppose you want to perform a backtest on, let me give you an example of something that is related to Indian markets, Nifty 50. Okay, so what I've done is like you want to run backtest from 2011 to current date. So you looked at the constituents of Nifty 50, whatever stocks are there in Nifty 50 today, and what have then you have taken the historical data up to 2011, and you have run a backtest on this. So what's wrong in that? The thing is that during that period from 2011 to current date, there are many stocks that would bust. Okay, that went bankrupt, that went bust, that were delisted. So it's not present in the current constituent of Nifty 50. So since you're not considering that, your backtest will obviously like perform better than if you have considered them, because those went down, they crashed, and they got delisted. Yeah. So it will give you like what to say, an overestimation of historical performance. That's called a survivorship bias. So another type of bias is look ahead bias. So this is like most of the people tries to avoid it, but may induce it knowingly or unknowingly. So what is that? This is like using information that is not available at the current moment. So during backtest, what you do is like you prepare data. Like this can happen at any point of time, like while preparing the data, while cleaning the data, while running the algorithm itself, or like while doing some other analysis on that backtest also. Like taking the whatever matrix you have calculated, during calculation of this matrices also you can induce this bias. So this is like, okay, suppose you have some data. Okay, there are some missing data in some, like consider you have data as rows, and each row is identified by a timestamp. So it's timestamp. Okay, so this goes in the increasing order of the timestamp. So goes increasing, and there's some missing data. So what you do is suppose you do a backfill. Backfill means those missing data are filled by whatever happened next day. So you fill the data whatever happened in the next day. So you fill those gaps. Now this is, you are using the next day data in today's case. Next day's data in today's case. When you run a backtest, just assume that you don't know whatever will happen in the future. But now backtest gets a peek at the future, which is not happening in real scenarios. So this is how like look ahead bias gets induced. So whatever data is not available at the current moment, you are using that. The third thing is something called storytelling. So people tend to make up some story that justifies some random pattern in the market or in the backtest. They say that, okay, this backtest is working because so and so happened, and that's what it's working. Like it's made up after the backtest result is out. Like they see the result is performing well, and they have thought that, okay, like they came up with some different idea, different hypothesis. This is working, and now it tends to be like, over the expectation of what they're thinking. Like they thought that it will perform fairly well, but it performed extremely well, and then they will try to explain that thing like based on some like logic that will create after like looking at the backtest. So that is called storytelling. So storytelling is also dangerous, because like what also like what people tend to do is like they tend to like optimize the backtest until they get that perfect backtest curve, and they say that, okay, this is working because so and so happened, so and so happened. This is because like they're looking at the backtest and they're optimizing it. This is the most like, what to say, dangerous thing you can do with the backtest. So that's what previously I have said. Backtest is not an experiment. It should not be considered like for proving that okay, my strategy is profitable and I'll trade it. The fourth thing is data snooping. So okay, now I've said that about optimizing, right? So usually what happens is you split your data set. As I've said, from 2011, if you're testing from 2011 to the current date, you'll split it into two parts. One is training and one is testing. So that is upon the researcher how they split that, how to do that split. So suppose consider like I'm training my like whatever my algorithm or strategy on like up to 2015, and I'll test it on rest of the data, like from 2015 to current date. I'll like see whatever performance happens in that. I'll not do any kind of optimization. So test data is considered to be untouched. So it is not touched until like full optimization is done, and it is final. Like now I need to perform this backtest on the test data. Test data is, once backtest is done on test data, it's no more test data. It becomes part of the training data. So what people do is like they train it on the test data and they go to the they train it on the training data and they go to the test data, and they also like try to optimize the test data backtest also. So suddenly the thing becomes like snooping into the test data. So that is the 4th point. Sorry. Okay, the 5th point is very common. Like 70 or 80% of the backtest you see has this problem, like ignoring transaction cost. First of all, transaction cost, or what are transaction costs are like your commission that you pay to broker for each transaction that you make, buy or sell. And it also includes slippage. It also includes something called maker and taker fees that are prevalent in crypto markets. And there are also like some other costs associated with like shorting and all those. So usually those things are not considered during backtest because transaction costs are very difficult to model, especially things like slippage and market impact costs. Those are very difficult to model. Like you cannot know it unless you interact with the actual limit order book. So that can be like it cannot be assumed. So it's very difficult to model transaction costs. So people tend to ignore it, like just ignore the transaction cost. Just let me show the backtest anyway. They usually assume that there is no transaction cost. So this is the assumption done, but in theory it might work, but in practice there involves transaction cost. The 6th is the outliers. So if your backtest is dependent on some few extreme outcomes, which we call outliers. So things like, okay, you have done the backtest and you say that okay, it performs good on like falling market. Suppose your strategy is on like sorting the falling market, and you have shown the backtest result from like 2005 to 2010. It will obviously perform good because there is the financial crash in middle. So those type of backtests are very dangerous because it's severely skewed and only certain scenarios are considered. And also like opposite also true, like if your performance is bad during 2008 and you say that this strategy doesn't work, that is also not true. You cannot invalidate the strategy that way. Like some people say that more the data is better, but there is also some other philosophies related to that. Also there is like a tech boom of 90s. So those things. Like the 7th is sorting. So I hope sorting is understood by all of you. If not, then okay, let me explain what is sorting in real quick. Okay. Suppose there is a trader here. Okay. He wants to like short some XYZ shares, XYZ stock, and here which is running at current price of $100, and he wants to short 10 of those. Okay, so what he needs to do, he needs to find someone who can lend him those 10 shares of XYZ. So he goes to a lender and lender lends him the 10 shares. So in return, he will pay some fees due to lending. So this is the lender. And what he does is, since you want to short it, he goes to the market. Okay, he goes to the market, and now he has 10 shares of XYZ. He goes to the market, he shorts those, and he gets the money. So he will get, since per share price is $100, he will get $1,000 in return. So $1,000 goes into his pocket. Now, while shorting, he usually people have a view that market will go down. Suppose market went down and XYZ is now trading at, like after a few days, so XYZ is now trading at $90. Sorry, $90. Okay. Now XYZ says, okay, I want to close my position. So what he will do is like he will go to the market and he will buy 10 shares of same XYZ because he have to return them to the lender whom borrowed from. So he goes to the market, he buys 10 shares for $90. So that is, he spends $900 and he returns those 10 to the lender. And in this process, entire process, he made a profit of like $100. So he returns him. So he bought the stocks at 900 and he sold the stocks at 1,000. So in this process, he made the difference, so difference of $100. So this is basically how shorting works. Coming back to the presentation. Okay, as I've said, like shorting involves finding lenders and who can lend you the securities. Okay, but what happens is like sometime in few markets, like shorting may not be allowed. Like Indian markets, shorting may not be it's not allowed. Okay, and sometimes in some markets which are like very less liquid, you may not find lenders. You may not find like people having that inventory, like demand of the markets and all. It's related to demand of the markets and so on. So you may not find them. So people tend to avoid it. Like while backtesting, they'll just short it and they will assume like, okay, it's, you can short it, but shorting is not an easy task. Okay, so explaining the types of backtest algorithms, we have vectorized backtest. So what is like it takes it uses the advantage of vectorization that is provided by NumPy and Pandas. So the entire loop of backtest is vectorized. So it's very fast. Since the vector is very fast but it's not reliable backtest because and it's just used for challenge check. So what I mean by that, like, it's very quick. You can implement it easily. Like implementation is easier. And for simple, strategies, it can be you can just run a vectorized backtest and you can know, okay, if it's working or not. That like just what to say, sanity check. Yeah, like if it's working or not. Shall I do some further research on this? It's easy to implement. Yeah, again. Next we have a for loop. So you can use a for loop. Like you can take the historical data and one by one you can like take the row, take the first row of the data set and pass it through the strategy, and take the second row, pass it through the strategy. That way you can check. But again, like this is something similar to vectorized backtest, but it's slower. Okay, and it's again not a reliable way to backtest because like it doesn't simulate the market. Actually, how market works, market doesn't work like you bring in just data comes in. There are many events that are involved, like how the order is executed. This is just assume that you get that and you get the instant fill. Okay, instant fill is done. Like as I've said before, it may not be the case that you will get instant fill. There may be partial fill. So okay, again, like for loop is used because it's easy to implement again. And the third type is the most reliable one. It's an event driven. So it's one of the difficult way to implement because it uses market simulation and it runs the backtest as the events in the market takes place. So what they do is like they drip feed the data. There is data, the data comes in and data comes in as an event, and whenever order is generated, that's another event, and then order is taken to a execution engine and execution engine process it, mixed, and you can also model the fill some way or the other. Like you can go as complex as you want, as accurate as you want, but this is the most reliable backtest that you can do. But that only downfall is that it's difficult to implement and it's slow. Okay, now we'll do some like in-depth understanding will understand some performance metrics and risk metrics like that are used in backtest analysis. So first is cumulative return. So cumulative return is calculated using this formula. So it's like 1 plus the whatever the return at the time, you multiply over all the returns. So you multiply them and you will get the cumulative return. So this is the cumulative return in log scale. Actually, this is the cumulative return in log scale. Returns will look something like this. If you plot the returns, it will look something like this. So this is in the percentage, sorry, not in the percent, this is in the returns. Okay, you multiply by 100, then it will be converted into percentage returns. And annualized return, yeah, annualized return is calculated using this. So it takes the cumulative return. So you take the cumulative return and raise it to the fraction of periods per year. So what is periods per year? So this is like if you do it on daily, like a daily data set, like you use end of day data or daily data, then this periods per year will be like 252. So there are 252 trading days. And if you do it on hourly data, then it will be 24 times 252. So that way, like you can scale it that way. And here is the number of observations, how many data points you have, how many returns you have. So that is n. Going forward, we have annualized volatility. So annualized volatility is just the standard deviation of that return. So I have some this return. So take the standard deviation of this. After finding the standard deviation, you scale it by the root of periods per year. So for annualized volatility, if, as I've said, periods per year, if it's daily data, it will be 252. So annualized Sharpe ratio. So it's calculated by annualized return minus risk-free rate by annualized volatility. So what is risk-free rate? Risk-free rate is the interest rate. So whatever interest rate you're getting on the bank, so that's the interest rate. So it's considered usually risk-free. So how to interpret this Sharpe ratio? Usually, I would say like interpret all of this. Like actually, okay, from analyzed volatility, lower the volatility, the better the strategy is, because less uncertainty. So less standard deviation, less uncertainty. And Sharpe ratio is a number that real number actually. So anything below 0 is like to be avoided. That is like when Sharpe ratio will go 0, when like annualized return is less than the risk-free rate. So it's better like to invest in the risk-free asset rather than investing in a strategy. If it's between 0 and 1, that like you can say like it's okay, like can be invested, but when it's above 1 and less than 2, then it is investable, and when it's above 2, then it's considered good, very good. So that's how Sharpe ratios is interpreted. Okay, now comes like tail behaviors of returns actually. So I have avoided formulas of both of this because like you can use any Python package to calculate this, but the formula is not that important. The intuition is more important to understand. So like skewness, like you have studied, I think in stats 1, ma'am have explained about the skewness, how to interpret the skewness. So there's something called positive skew, negative skew, and symmetric. So we want to avoid trading strategies or assets that have negative skew, like the return distribution is negatively skewed, because like then this like negative returns are more frequent to happen. So like sorry, not frequent, more likely to happen. Okay, so negative events are more likely to happen because it's negatively skewed. So skewness is usually like accompanied with kurtosis. So kurtosis like explains the fat tail behavior, like if it's fat tail or not distribution. So if you see here, you have your positive kurtosis, you have a normal distribution, you have a negative kurtosis. Negative kurtosis usually have a fatter tail. If you see, that means those extreme events are more likely to happen. It is good, like if this positive extreme event happens, but if this negative extreme event happens, that's just like undesirable and it will obviously incur loss. So we want to avoid strategies that have negative kurtosis. So we want to avoid strategies which have negatively skewed and negative kurtosis. So remember, like I've shown you some with some things at the beginning, like here you see here you can find the skewness number and kurtosis. So it's slightly negatively skewed, and but it has a fairly good kurtosis. Okay, finally, okay, not for maximum drawdown. So what is maximum drawdown? Is like if you see a backtest, and this is the return actually. So this is the cumulative return of the backtest from any peak that is makes and to the trough, to the next trough, that is considered as drawdown. So here is a drawdown, and from here to here, here to here is a drawdown, here to here is a drawdown. So anything like that goes below. So when it makes a new high and it goes below, then that's a drawdown. So among all this drawdown, I want to find whichever is the maximum. Okay, so that is called the maximum drawdown. So actually drawdown is well represented by something called an underwater plot. So if you see here, you can check this dip. So this is the maximum that dipped. So this should be the maximum drawdown. So it's like something more than 20%. So around 21% or something, 20 and 22%. So sorry, it's less than negative 20%. So it's like around negative 20%. So the underwater plot gives you that view of drawdown. Okay, this is the final risk matrix. So this is called something as value at risk. This is a bit complex. Like first of all, I thought not to include this, but later I found this good picture at Wikipedia to explain. So this is the return plot. Consider this is the returns are plotted. So its mean is around like 1. So that is a good thing. What value at risk says is like, if that extreme 5% event happens, so extreme 5% negative event happens, what is the maximum return like you would lose? So here value at risk is negative 0.82%. So you would lose this much. So this is the negative return that you will receive if this extreme 5% event happens. This is what negative return you are expected to get. So it's 0.82. So it is value at risk. Okay. We have our first backtest, time series momentum. I'll check that. So if anyone would like, they can like come along and run this alongside me and check it by themselves. Okay, I'll be using something called Alpaca. Like I have mentioned it yesterday also. They're a brokerage, so they provide the trading API. So I'll be using their trading API to like fetch the data. So what you can do is like if you want to run this thing, like you need API key. Okay, you need API keys. API key. So to get the API key, like you can go to alpaca.markets, and from there you can just register. It's simple registration, nothing complexities involved. Like you can just register using your email. That's it. And then here you'll see something called your API keys, and you will get the API key, and you will get below here something that is called API secret that is visible only once. Make sure to note it down, and you will get the endpoint. So note all of these 3 down in something called a config file. So if you go to the GitHub of this workshop at day 2, you'll file something called config.cfg. So this is a file. Paste your API key here, paste your API secret here. Okay, and then what you need to do is like copy that file, like download that file first locally, then you copy that file over here, then you're good to go. So I'll do mine. So why I have done this way, like I could have like written my API keys like over here, right? Directly over here. But I have avoided that. This like maintains some sort of security for your API. This is a good practice. Okay. So I have retrieved my API key, API secret from the config file. And now to get the bars of Apple, I'll take a day time frame, 1 day time frame, daily bars. I'll start from, okay, start and end. I'll start from 2020, April 2020 to April 2022. And here adjustment is all means the data is adjusted for everything like splits and dividends. So if you want to see what are corporate adjustments, you can read about it. You can ask some, if you need some resources regarding this, I can also provide regarding that corporate adjustments. Okay, now I'll run this. Okay, I might have changed the API key, that's why it's showing, so sorry for that. The API keys has been changed. Maybe that's the reason I'm getting, but you will get the data frame here. Okay, and when you plot the close price, this is the same thing like I have shown you on the previous notebook also on time series momentum. So you will see this. Okay, after plotting, and then I've done similarly like I've used the fast moving and the slow moving average, and I've calculated them, and then I've calculated the sides. Okay, so I have created a column named sides. So I have assigned all those values to 0. Now what I've done is like for vectorization, I've checked wherever like the fast moving pandas allows this. So I'm doing it using panda. So whenever the fast moving average is above the slow moving average, then I'm treating it as a long signal, and this will basically give me true or false value. Like doing this kind of comparison will give me true or false value. So wherever this condition holds, it will give me true. Like there will be an array and it will be true. Then wherever it doesn't hold that condition, that will be false. So similarly for slow moving average. And then what I did is like long signals, whatever the long signals I have, in the side column, I have considered it as 1, and whatever the short signal I consider is -1. Then I have calculated the returns of this closing price using something called percentage change, and that is the return of Apple from this point to this point. So I'll get the return on that, and I multiplied it with the sides. So that is also another step in vectorization. So I multiplied the sides. So wherever like market is going up and I have a positive signal, then my return will be positive. If this market is going down, then it will have negative return, and I multiply with -1, then it will turn to positive. So that is basically sorting. I'm taking advantage of sorting. And yeah, and I've done a cumulative sum of return to plot the equity curve. If you again like that plot again for moving averages and the price. Now I have done some plot. So this is the same thing as above. You see the same plot. This is the position. How whatever the position I've done. This is like this side. What I've updated. So side stays 0 because nothing was entered at this point. Here it goes long because the fast moving is above the slow moving. So it goes long. It goes long till this place, and as soon as it crosses down, it takes short position here, and again here it goes long position because it's above. Here it comes for short position. It goes back and forth that way, and this is the, I have to say, cumulative return. So yeah, it doesn't look that good, but that's what it is. Now whatever performance metrics I have talked about, I have calculated that. Like I've calculated cumulative return. The formula is here, and annualized return, annualized volatility. Then this is a trick to calculate maximum drawdown. You might have realized by now it's not trivial to calculate the maximum drawdown. Then, as I've said, like kurtosis return can be calculated. Just you have the returns, you have the this what to say returns are not shown here, but okay, returns are calculated here. So you have this return. So you take the return column and just say .skew.curt. So these are built-in methods in pandas. So you can get the stats, and value at risk is calculated at fifth percentile. So taking the whatever the return is at fifth percentile. So I've taken that and multiplied by 100 to get the percentage. So this is the report of that. So the strategy has 20%, around 20.5% cumulative return, annualized return of 9.69%, annualized volatility of 29.34%, Sharpe ratio of 0.19. Not good at all. I wouldn't invest in this. And drawdown. So whatever talked about maximum drawdown. So from the picture trough, it like at one point of time you would have seen a minus 34% in your portfolio. So that means that. So this is the maximum we would see. Kurtosis skewness is like okay, kurtosis is also okay, and value at risk. So when this extreme events happen, you would lose around 3% at a single moment of time. Like at a single day, you will lose 3% at a single day. This is accumulated over time. This is at single day. So yeah, this is momentum strategy. I'm having this error because like for demonstration purpose, I have changed that API multiple times, so that current file might not have that updated API key. So I'm having this error. You shouldn't have this error. Now going forward, we have pairs trading. Okay, so pairs trading, I've shown a different, like for this, you don't need any API. This is like pulls data directly from Yahoo Finance. There is a package called Y Finance. So you just install that package. Okay. It doesn't involve any API key and sort of things. You just need to do this. It doesn't involve going to any site and signing up also. It will take some minute and it will install that requirement. Okay. Now doing some imports. Oh, again. Okay. There's some issue with this. Okay. So what I've done is, as I've said, for pairs trading, you need to have a certain like universe of stock to consider, like to search for the pairs. That is the first step. So what I've done is like I have pulled S&P 500 from Wikipedia. So if you go here, and you will see like constituents of S&P 500. These are all the constituents. So there are more than 500 stocks actually in S&P 500. If you like think that there is only 500 stocks, there is more than 500 stocks in S&P 500. All those are listed here. So what I've done is like I've scraped the data, I've scraped the table, and this table is here, and I have took only those airline sector stocks. So these are the like 5 airline sector stocks. So there is like let me see how many of them I know. There's Alaska Airline, American Airline, and there's United Airline. I don't know about this too. This is Delta, I guess. Yeah, this is Delta. So these are ticker symbols of them, and I've taken again the data of past 2 years. So from 2020 to 2022, from April 1st to current April 1st. Now I've downloaded the historical data using that Yahoo Finance. So Yahoo Finance, just import Yahoo Finance and say Yahoo Finance to download, and I've joined those symbols, like the symbols were in list. I've joined those symbols as a string, and they're separated by space, and started, ended, and give me the adjusted closing price. So this is same like adjusted for splits and dividends. This is called adjusted closing price. So I've got the adjusted closing price of all those. This is the head. Okay, did I run this cell? Okay, I'll run this cell again. Okay. Now you have seen that function in that notebook of Quantitative. So I have used the same function to find like co-integrated pairs. So I plotted the heat map of the p-values. So you see like these are some of the promising pairs, those dark greens. So dark greens are a promising pair. So one pair is like American Airlines and Alaska Airlines. And you see one is this and LUV, UL and LUV and LUV and Alaska Airlines again. So you see like these are American Airlines and United Airlines. So these are the, so we have got 4 co-integrated pairs actually. So within the airlines industry, 4 co-integrated pairs. I've considered only one. So I've considered Alaska and United Airlines. So this is something like I avoided. Like first of all, I thought that let me go using the OLS regression, but this involves some in-depth concept of understanding how regression works, since regression is not taught yet, and I didn't assume regression for this workshop. That's why I avoided this, and I considered the ratio for considering the spread. So I've calculated the ratio of them, and also I've taken the spread returns. So a return of stock Y, return of stock X, and minus them, and I get the spread. And this is the spread actually. Spread calculated from the ratio, and this is the mean, and I have z-score normalized it. So this is the z-score normalization, and I have selected the +1 and -1 here. Now I have thought to use some class and make it a factorization backtest class for this pairs trading. Okay, so first let me go to run. So run uses get position. So this get position function gives us the position that you have seen earlier, like it uses factorization to get the position. So it checks wherever like the z-score is below the threshold, and checks that is long entry, and checks wherever it is above 0, that is long exit, where it is above the threshold, positive threshold, that is short entry, and when it is below 0, that's the mean, and that is short exit. So similarly, I have calculated the long entry and exit. Like I've given like exit will be always be 0, so we don't hold any position during exit, and when long, we'll continue having $1 invested in Y, and $1 shorted in X. So an opposite for shorting. So that's why it's minus, it is inverse. Now we do some shifting, like as I've said, like to avoid look ahead bias. So to have a look ahead bias, I've shifted it by 1. So I've shifted it by 1. Sorry, shifted below by 1. So there is no look ahead bias in that. And yeah, I've filled the whatever the NA values was. I did the forward filling. So backward filling is dangerous, but forward filling is like acceptable because you're using past data to fill in the future data. And then combine long plus short position, you get the entire position. So you get the position, you multiply the position with the returns, whatever returns that was calculated here. Okay, so multiply that by return, whatever the position, you get the return of the strategy. So you take the cumulative return. So you take 1 plus you take the cumulative product, then you get the cumulative return. So this is a function for plotting. So whatever you see the plots, this is a function for plotting that. So I've run the test, backtest, factorized backtest, on this pair, Alaska Airline and United Airline, and this is the spread, and these are the positions. So here's 0. So here they've shorted, and soon, like very soon, they closed the position. The position was closed, and then again, like shorting happened here, and position was closed. Shorting happened, position was closed, and you see this is the PNL. This is the PNL. Sorry, this is not the PNL actually. Yeah, this is not the PNL. This is the cumulative return. I should have changed it here. Okay, cumulative returns. The backtest trend and generate the plots. Strange. It's still showing PNL for some reason. Maybe this is not executed. Yeah, that was not executed. So yeah, this is the cumulative return. So it's start from considering that you have 100% of your portfolio, and your portfolio like gave over 100% return. So it almost doubled. Yeah, it actually doubled, more than double. So the performance will say us it's the same function that I've used previously. So if I calculate, you see some absurd cumulative return like 100, 303%. So yeah, double over. And annualized return of 42%, volatility of 22.62%, Sharpe ratio of 1.71. Good. And very low drawdown of like 13.74%. There is slightly negatively skewed, and curtosis is quite good, and value at risk is also good enough. But have you realized the problem here? Like, anyone have you realized the problem? Like, this return is really absurd. Like, it's way higher, don't you think? I might have made some mistake here. Anyone would like to answer? You can raise your hand, like if you want. We'll unmute you. No one? Okay. So as I've said, like the 7 sins of backtesting, I have done one sin here. Like that was like like we try to avoid it, but it occurs. So that is look ahead bias. So see, like while calculating z-score, it takes a series. So I have given the entire spread, like whatever the spread is there, entire spread, and it calculates the mean of the entire spread. So if I start trading at this day, like practices assume that you start from where the data starts, and the rest of the data is future data. So mean considers everything, like up to this point. So mean considers the entire future of that. And standard, similarly for standard deviation. So I have considered entire series for standard deviation. Like I'm assuming that everything is known to me, but backtest assumes that whatever at the at the point wherever like we start a backtest, only that thing is known, rest are unknown, rest are like future, rest is future. So here, like it is induced, look ahead bias is induced unknowingly. So that is fault of the researcher. So what we can do to fix this? Again, we can use the concept of rolling mean and rolling standard deviation. So it's like you can think as moving mean or moving standard deviation. So this is the function that I used for calculating the rolling z-score. So rolling z-score, what it does is I have given some window like here 22 days. It looks back at the past 22 days and it calculates the mean. It looks back at the past 22 days, calculates the standard deviation, and it calculates the the z-score based on that, based on those rolling minus rolling standard deviation. And I plotted that. It looks very different from what you see here. What z-score you see here, it looks very different. It looks way volatile. Now, let me run this. Now, if I run backtest on this rolling z-score, surprisingly, it's no more like doubling the return. It's not surprise actually. It gives like something slightly higher than 30% return. And you can see that the frequencies are more common, like very frequent positions are taken here compared to like the previous one, which is mostly flat. Sorry, in this region it's mostly flat. Here it's sorted, but here it's like way frequent positions are taken. Like, and if I calculate the performance metrics, we see it's like slightly above 30%. Annualized return came down to 14%. Volatility came down to, sorry, volatility increase, I guess. Yeah, volatility increased slightly. Like it was 22% earlier. Now it's 23.59%. Sharp ratio decreased hugely. So Sharp ratio earlier it was 1.71. Currently it is 0.45. Sorry, 0.45. And we have maximum drawdown. Maximum drawdown, I think it increased or decreased. Let me check. Yeah, it increased. Maximum drawdown increased. So skewness is slightly worse than the previous one. Kurtosis is also like lower than that. Value at risk increased. So value at risk is 2% now. Earlier it was 1.8%. So yeah. You see, like this is like making the backtest somewhat realistic, because earlier look ahead bias was introduced. Now it was removed, but still like it misses those things like transaction costs and looking at the scenarios of sorting and all, because it involves sorting, right? So we missed that thing here. Okay. So now you might be wondering what happens like if we change the parameter, like tweak the parameter of like thresholds. Tweak the parameter of this threshold, like slightly increase them to 2 and -2. Okay, let's do that. Let me copy this entire thing because thresholds are inbuilt here. Okay, thresholds are given here. Okay, yeah, I can use threshold over here. Okay, so let me copy this new cell, and here I include threshold to be 2. So it will do +2 and -2. And let me run the backtest again. Okay, backtest is ran successfully. Now let me plot the curves. Next, I need the performance. The return decreased, cumulative return decreased, but maybe like the risk parameter might have improved. So you never know. Let's check. Annualized return and cumulative return has decreased. Annualized volatility has decreased, so that is a good thing. Sharp ratio has decreased. That's like you can say that like it got worse by taking 2 as a threshold. So yeah, you can do the staking, but again, like this optimization will lead to backtest overfitting, which will like involve like the sins. So you will at some point of time at tweaking this, you will get a very good looking curve. You will get very good looking stats. Like you will tweak these parameters. You will tweak the bets you make. You will tweak everything like to get a good backtest. That is pure backtest over everything. And at the end, you will like do storytelling, like to justify that pattern. So yeah, that's on pairs trading. And finally, you can end of this session. I'll give the reference. So let me share the slides. Okay, first of all, we have this book. I think like if you want to learn how to do backtest, how to like code algorithms, trading algorithms, then I think this is very good book, Successful Algorithmic Trading by Michael Holzmoor. The second one is if you want to learn Python for finance, like this is a very great book. Like it explains everything. Like it covers from like data, collecting data, how to like manipulate data, how to clean data, how to set up, how to backtest, how to like run a strategy live, everything. Like the new edition covers everything. So this by Dr. Eve Hilpich. The third thing, again, the same book that I have mentioned in the previous slide, Algorithmic Trading and Winning Strategies. So Winning Strategies and the Rationals is by Ernest Chan. The fourth book, like this is, I thought like about not including this, but it has a chapter on dangers of backtesting, and the 7 sins of backtesting was taken from this book. So I thought to include this book. So this is a pretty advanced book. Like it involves concepts of machine learning. So if you don't want to like venture into world of machine learning yet, then I'll say you avoid this. This is very heavy on the mathematics as well. So it's Advances in Financial Machine Learning. Like I consider this as like this is a one of favorite book of mine. So Advances in Financial Machine Learning by Lopez de Prado. Okay, on now we have the papers. So the paper I've mentioned, 7 Chains of Quantitative Investing. This is a paper by Deutsche Bank. So it's by Liu and others. The second book is Backtesting Protocol in Era of Machine Learning. This is by Campbell Harvey and others. And the final is like on effects of backtest overfitting on outsample performance. So this paper discusses like whatever backtested, how the out of sample performance will look like. If you overfit a backtest, what effects it will have on the out of sample performance. So this is a pretty good paper on that. So it's by Lopez de Prado again. So these are the references. Now, yes, I'm open to Q&A. Any questions? Yeah, Vinay, go ahead.
Hi. So in the sample trades that you've gone through, I just wanted to know at every trade signal that is generated, are we buying $1 worth of share?
In the pairs trading?
Yes, in the pairs trading.
Yeah, I'm assuming that we are investing $1.
For every buy signal?
Yeah. In every buy signal, we're investing $1. In every sell signal, we're shorting $1.
Yeah. So in real term scenario, how do you factor the trade size? For example, a sell signal and a buy signal also depends on the magnitude of the signal. For example,
definitely.
If there's just a 5 cents uptick, then you just buy $10 worth of share. But if it is a $50 downtick, then do you still sell only the portfolio, $1 portfolio, or you sell the entire, you exit the entire position? So how do we tackle money management and risk management basis the magnitude of the moves?
That is like topic of day 5. That is like bet sizing. So whatever talking, it's called bet sizing. So it depends on factors like volatility of the market and some other factors as well. So we'll discuss that on day 5. And whatever we've said about like how you split the money between those two, stocks when you like short the spread or long the spread, that is you can calculate. Suppose you have some maximum budget. Let me say you have $1,000 maximum budget, and there is a strategy of dollar neutral position. So you can create some dollar neutral position. That way, like you split that maximum budget into half, so it will 500. Now, what you can do is whatever the current market price of stock X, you can how many shares of that you can buy with $500, you can buy them, and but similarly how many you can short for stock wise, you can do that. So that way you can calculate it. So that is usually like called a dollar neutral position. But in US we have something called fractional shares, so that involves like buying notional value. So if you want to buy $500 worth of shares, you can buy it directly without worrying about the quantity. So yeah.
So that means part ownership of the shares is also allowed?
Yeah, like a fractional shares, like if you want to buy 1.569 something like that decimal, so you can buy those amount of shares also. So those are called fractional shares.
Yeah, that's interesting.
Yeah.
Just a side question. I mean, you talked about VAR, but I'm just curious to know if the industry is still using VAR, or have they moved to expected shortfall, given the criticisms of VAR and the crisis?
See, evaluate risk is a classic like indicator of risk. So if you study like any financial engineering textbook, or if you go into any financial engineering course, they will teach you VAR. And like VAR, there is a different ways of calculating VAR. So evaluate risks actually. So currently like people are also employing machine learning techniques to calculate the value at risk. So there are various methods, like whatever method you have seen me doing, that is Cornish-Fisher method. So there are various methods. Yeah.
Okay, thank you.
Anyone else have any questions? Meanwhile, let me check if we have questions on YouTube. Okay, so people are like concerned about that I'm not discussing things about Indian markets and like doing only for US markets. See, this is not about markets. This is like, this can be generalized. There might be some difference like on shorting and like whatever I said about fractional shares that are not available in India. But whatever the concepts like of the strategies like pair trading, momentum, and whatever the risk metrics I have like explained, those are common for like over different securities classes, different markets. So yeah, that is generalizable. So I'm not teaching anything market specific here.
Probably what you could do is, on day 5, you could share some links which are specific to Indian market where we can explore further, like where we can do some back testing and that kind of things, specific to where we can get the data of NSE, the feeds and all that. Some links so that we can simulate in the Indian market.
Okay, that might be difficult for me because like I don't usually work on in the market, so I might not have those links from there. So, but yeah, I'll try to do that. Yeah, I'll try.
Okay. Does Interactive Broker provide it?
Yeah, they do provide market feeds.
Okay.
Okay, so if there are no more questions, then I'll explain the task for the day and wrap up the session. Okay, so let me share my screen again. Okay, task for day 2. So this is the task. So there's a YouTube video that I want to watch. This is by ManHL. So ManHL is a quantitative hedge fund based on Europe. So I wanted to watch this video. They explain something related to a time series momentum. They explain the strategy of time series momentum that uses slopes to calculate the momentum signals. Okay. Then I want you to perform a backtest and collect the historical data using Alpaca Trading API. I have shown you, right? You also have that notebook with you, so you can reuse that code and select the stock or whatever ETF, whatever of your choice. Mostly, I think Alpaca doesn't provide things like options, and yeah, I don't think Alpaca provides options. But yeah, choose a stock of your choice. You can also choose an ETF. Perform the back test and make sure that the duration is good enough. Like it should not be less than 5 years. Make sure that the duration is more than 5 years. You can use daily data for that. And vectorized backtest is preferable, but if you can't perform a vectorized okay, so basically why vectorize, someone would perform for loop if vectorize is fast and both have the same functionality, because there are some logics which are difficult to vectorize. So what people usually do is like they go with for loop. For loop is the easier version. You can directly use if else conditional statements and code those logics. So for this, I think vectorized backtest is doable. Vectors backtest. So you do the vectors backtest. If not, then you can do for loop as well. It's fine. Okay. Then calculate the risk and the performance metrics. So you have that, that function, or you can use something else. Like there are also libraries like PyFolios. You can also use PyFolio if you want, which is provided by Quantitative. So that will give you a TA sheet. So whatever you've seen at the beginning of the slide. So and here, okay, these are everything. These are generated. These things are generated by PyFolio. PyFolio will give you everything. Just provide it with the return and the benchmark. It will give you everything. And the third thing is that next I wanted to like plot the cumulative returns against a benchmark. So you need to select a benchmark. So benchmark is usually like where you compare your strategy against. So usually it's the market. So if you're doing in the US market, it's best 500. If you're doing it in Indian market, it'll be Nifty 50. So usually the market is the benchmark. So how it performed against the market. So that shows that. So plot the cumulative return against the market's cumulative return. So benchmark's cumulative return. Also plot the drawdown and the rolling Sharpe ratio. So by drawdown, I mean the underwater plot. And you will get extra points if you include transaction cost. So during the backtest, if you can include transaction cost, then we'll get the extra point for that. And finally, use Google Colab. Make sure that the link is shareable and it's visible for everyone at the ITM domain. Last date of submission is at the 5th of May. And submission form link is given here. So yeah, I'll make the slides. One more thing I want to say, like whatever is available, slides are available in GitHub. Like it is updated every day after the session ends. So whatever you see that might not be updated yet, like so tomorrow's slides might not be updated yet. Like they are available, but there might not be like the updated version. So whatever slides are available after the session, they are the updated version of the slides. And yeah, so if you don't have any questions, then we'll wrap up today's session. Vinay, if you have any question, you raised your hand.
No, it was the past question, so I'm good. Thank you.
Okay. Okay. So we'll see you tomorrow. Tomorrow at just give me a minute. So tomorrow's session starts at a different time. So we'll start from 9. So see you tomorrow at 9 p.m. And tomorrow's sessions will be on like whatever we've discussed today. We'll code a trading strategy for live market. So we'll see how to do that, like using a broker API, how to send orders, how to like receive data from the exchange regarding the fields and all everything. Like it will be done in the paper account. And for that, I recommend you that you make an account with Alpaca and get your paper trading API keys. So good night, guys.
Thank you.
You can end the call.